Hello, my name is Russell Myers. Welcome to Issues Unite. So, a person can pay attention to the stock market going up and down, and you know, it's up one day, down the next. However, for weeks, nobody has been talking about the obvious that the market is not climbing any higher. It is dynamically static. Even though there are ups and downs, when you average it out, it's flat. Now, this could be a good thing, which would indicate a stabilizing economy. It would be good if the stock market were going to remain that way, but it will not. This is a sign of the impending collapse, which I have predicted for several years. Of course, there are a lot of things I didn't take into account, such as quantitative easing, but we'll skip that. All right. In truth, the crash would have happened, and at least in 2019, if not many years earlier, if the Fed had not been supporting the market through operations that I've talked about on numerous occasions. And I'm not going to review all those actions here. One thing is certain, the Fed recently announced that it has the intent to begin tapering. That does not mean that they are going to unwind the balance sheet anytime soon or stop printing more money. It just means that they are slowing down on how much they are printing and pumping into the market. They are just slowing it down. However, just that intent is enough to make the stock speculators cautious. Cautious means taking less risk. I've stated since 2019 or longer that once the stock market stabilizes, there will be no place to go but down. Stock market speculators do not place their money in the market as a savings account. They place their money in the market to make more money. They know as well as I do that keeping their money in the market when the market is static rather than climbing is a risk. The market can turn down very rapidly in mere minutes. So they are highly likely to liquidate their holdings to remove that risk. They've been holding out to be sure if they could squeeze the very last pennies out of the economy before cashing out. Gradually, they have also been moving their money into hard assets, such as the real estate market, which is driving up the cost of living, of housing. Of course, the real estate market has been helped along by the Fed, so the same investors are likely to be watching what form the taper will take because that has not been made clear. One good indicator, though, is that 2 Fed presidents have resigned after having to divest from their stock holdings, while Powell had to sell off his holdings in REITs, real estate investment trusts, which had been propped up by the actions of the Fed itself. And the 2 that resigned just resigned so that they could use their insider information to continue trading stocks. They divested from some stocks, but they had the full intent of repurchasing probably the same stocks. All right, none of this is abnormal. You would do the same thing and may have at some point. You put your money in a savings or retirement account. It pays very little, stays static, or even declines. What do you do with your money? You take it out and you try to find another place to keep it where you get a profit from it. There is something sick and twisted about the whole idea of placing your money into a holding account of some form and expecting to be paid a profit for doing so. That expectation is repeated millions of times by millions of people, most of whom never ask where the profit is supposed to come from. The only place it can come from in real terms without appropriating it from somewhere else is the creation of more currency, which decreases the value of that currency, making any profit meaningless. The purchasing power of that currency is diluted. I know MMT proponents will argue against this, but not even they can deny that the value of the dollar has declined by at least 95% in the past century. They conveniently try to ignore any question of why that is true. I am not expecting a sudden, precipitous crash to happen immediately. I expect much of what we are seeing now to continue. A stair-step phenomenon, with the stock market gradually declining, with an occasional slight rise and then drop again. Though that will only continue for a limited period of time as the larger speculators gradually move their funds into more stable investments or offshore to other countries. However, the same effect will be the result. They will be moving their money out of the stock market and cashing out under cover of the lesser but still present Fed bailout to continue, obscuring the fact that real equity is declining at light speed. All this while encouraging smaller investors like you to keep their money in the market or even invest more. In this way, stock values are kept elevated while they sell off shares. Eventually, there will come a tipping point where the large investors feel they have collected all that they can from you. That is when we will see a massive sell-off across the stock market, and the entire market will collapse almost overnight. Some people will try to compare what is happening to previous crashes. However, technology has changed over the years, and unlike previous crashes, which took months or years to occur, information and algorithms will result in a different result. In 1929, and later stock market declines, trades had to be conducted manually by human traders on stock floors. In some cases, many years back, selling stock meant you had to have the physical stock to sell. Today, stocks are electronic impulses, which buy and sell in milliseconds. Millions at a time. This is why the stock market is so much more volatile today than in past decades. Today we have funds which invest in other funds which invest back into the first fund. We have funds which invest in nothing at all, just money sitting in accounts pulled out of the economy, looking for ways to game the system. Worst of all, we have commodities futures which buy up assets like oil and food before they are ever produced, driving up the price of everything you can imagine. The next crash may happen in days or weeks or months, It definitely will not take years before it happens at this point. The stock market will not tolerate a static environment for that long. Whenever the next crash does occur, it will be far worse than anything we have seen previously. Even the very top Wall Street economists have admitted for years that the stock market is desperately overly leveraged, far more than in 2008. The highest highs lead to the most drastic drops. This time there will be no resources to save the economy or the market. The Fed has used up all their ammo. In 2008, China helped the U.S. by loaning us money. Yet we have destroyed that relationship, in addition to China having their own issues to deal with at the moment. They have become strictly competitive for resources and economically adversarial against our government. Other countries are in debt. Numerous countries have been slowly selling off U.S. treasuries and bonds. Even if they buy U.S. treasuries, they can buy them on the open market between each other. So new debt issued by the U.S. Treasury Department does not gain new external funding. Old treasuries just mean old debt, which matures faster. The Fed is the buyer of last resort, and printing more money just means creating more debt. So the government bonds, which they print, they keep on printing bonds, and bonds are debt. The Fed prints money to buy the bonds, which is debt. We literally have debt being used to buy debt. No resources back any of that debt. We have trade deficits with every country we trade with, and at some point it is highly likely that the countries we owe are going to want to be paid. Printing more money that has no value is not going to suffice to settle those debts. I've encouraged people for years to invest in physical precious metals, not metals investments accounts, which are futures markets. And that means buying materials which have not yet been produced. Right now, the price of metals is down. That's because of the futures markets. Large investors have been manipulating those markets. Once investors start demanding delivery of the physical metals in large amounts, the price of those metals will skyrocket because there will be a shortage of epic proportions. Plus, even if the currency declines, metals will hold their value or increase by the same amount as the currency decline. Maybe even more, depending on what happens in other countries. So I will repeat this advice. Take at least some money out of the stock market and buy physical precious metals. Demand delivery. Gold, silver, even copper. It will be far more secure than any stocks or bonds. For now, we are in a set and wait pattern. We know what is coming. It's just a matter of when. Please share this video. Talk about these subjects. If you can, Please donate $1 a month to help expand the channel, and I will catch you in the next one.